So well, let's discuss some of your individual funds, starting off with Franklin India Bluechip, which is, the oldest equity fund from a private sector house in India. When I look at your portfolio, again, it's concentrated. So the top 10 stocks have, about 45% exposure. What's been the rationale behind keeping that exposure? Because within the top 10 stocks, the outperformance or the alpha has really come in only from the private sector holdings, not from the leaders of the other sectors that you've chosen. So what's been your rationale behind keeping your conviction with the top 10 holdings?
Well, some of the top 10 stocks are stocks like Bharti, which, like I explained earlier, have not done too well in the past 2 years or so. We think that there is a tremendous upside potential in a stock like Bharti going forward. So, if you look at the top 10 portfolios, apart from the private banks, some of the other stocks have underperformed, and we think that, going forward, part of this underperformance will be made up going forward, which is why, you see some of those stocks in the top 10.
So stocks such as Reliance Industries, Infosys, you spoke about Bharti. What is your conviction in these stocks? Is it really the fact that you expect a turnaround in the cycle, turnaround in earnings? Or do you believe that they can help in mitigating the downside risk that may come to the portfolio in a volatile market?
Clearly, I think a stock like Reliance is a very large weight in the index. We are relatively underweight compared to the index as far as Reliance is concerned. We think that the current price probably reflects all the bad news which is there. And the stock probably will act as a defensive going forward. As far as Infosys is concerned, it's something which we've held in the portfolio for a long period of time. Yes, there have been periods of time when the stock has not done too well. We are still positive on the prospects of the company going forward, and we think that we'll hold on to this.
Is that a broad call across IT?
It's not a broad call. It's a specific call vis-a-vis Infosys. Again, relative to the benchmark, we are underweight in the sector as well as the stock. But we think, given the long-term performance of Infosys and the quality of the company, we think this is a short-term aberration, and the company should start doing well once the problems are sorted out in the US.
The reason I ask you that is because, from a market perspective, post the earnings, there was a lot of focus coming in on TCS and HCL Tech as the preferred trades in IT. You have not changed your view?
We have not changed our view.
Okay. Private banks versus public sector banks. There is one camp that believes that public sector banks can be looked at purely on the basis of value right now. The other believes that, private sector banks are cleaner in their balance sheet, the growth potential is there. So what if they're coming at a higher price? That scarcity premium can be allocated. What's your view?
We obviously belong to the second camp. We think that the performance of the private banks have been far superior in recent times related to the PSU banks, and most of the private banks seem to be well capitalized, and that will help them to capitalize on the growth opportunity in India. PSU banks, on the other hand, while they do appear cheap, in terms of capital adequacy ratios, I think the government has to infuse capital in them for them to grow going forward. And that at this point in time doesn't look like a distinct possibility given the government's position. Apart from that, we prefer banks which are a play on the retail segment, and private banks are a better play on the retail segment vis-a-vis the PSU banks.
Engineering as a sector, as part of this fund itself, you were overweight on the sector in 2009-2010. How do you view the prospects of the engineering space? Again, two camps out there as well. One believes that they've been oversold and the cycle will turn, and that's why these stocks look attractive at these valuations. And one, of course, believes that, things will take their time and these companies need to still get their act together.
What we focus on when we look at a company is to see whether the return ratios justify investing in these companies. And if you look at the sector, there are not too many companies which earn more than the cost of capital over the long run in the sector. There are companies like Cummins, for example, which have done that in the past and have consistently done that, which is why, if you look at our portfolios, we have stocks like Cummins and not the other stocks.
The next fund is Franklin Prima. Now, in this fund, I've seen that, without increasing the risk of the overall portfolio, you've been able to generate above average returns. How have you managed to do that?
Well, I think alpha really comes in focusing on good quality companies which can deliver above average return on equity over the long run. And we tried to sort of focus on good quality companies in the mid-cap space. There would be periods of time when these companies underperform the broad market, but in the long run, we've seen that focusing on quality of the companies and focusing on return ratios stands us in good stead, and it has helped us definitely as far as the Prima fund is concerned.
What are broad benchmarks that you follow to a certain risks for a company and not make them part of your portfolio, or conversely add a company based on attractive valuations?
Well, there are many metrics, when you look at valuation, there's no simple benchmark which we can spell out. But in terms of what kind of companies we look at, definitely we look at businesses which have long-term growth potential, businesses which can protect margins both in a down cycle and earn superior margins in an up cycle, and also we definitely focus on the quality of management and their attitude towards minority shareholders.
What about picking up mid-cap banks in this sort of a market environment?
Valuation metric does not change, depending on the size of the bank. The metrics are the same. We focus on things like price to book and return on equity for mid-cap banks as well. Within the mid-cap space, again, there are old generation mid-cap banks and newer generation mid-cap banks. We are partial to the newer generation mid-cap banks because they seem to have built a fairly good liability franchise and also a retail portfolio. But we also have some old generation private banks where we think because of change in management, there is a re-rating opportunity going forward.
Do you think that the scope of banks getting re-rated is more prominent or more prevalent in the mid-cap universe?
I think so, yes, because the growth potential for some of these mid-cap banks is much more, and some of them are changing color in terms of what they're trying to do. So from a very low price to book or low price earnings ratio, they can get re-rated if and when the strategy works out.
Right. Pharmaceuticals is another theme that is very prominent in this fund. Which segment of pharmaceuticals are you most bullish on? Generics, patents, healthcare, retail? They're very niche businesses within the sector.
If you look at the mid-cap pharma space, there are not too many companies which have IP related revenues. Most of them are generic players. There are a few MNCs in the portfolio, MNC stocks also in the portfolio. So we are partial to good quality mid-cap generic players, Indian generic players, and also companies like Pfizer, for example, which is an MNC where the cash generation is so great that we think that it looks more akin to an FMCG company than a pharma company.
The next fund is Franklin Prima Plus, which is a large cap and a mid cap fund. What is the large cap to mid cap ratio that you keep in this fund at all times through cycles and through the kind of sell-off that we're seeing in the market right now?
The overall focus is to give exposure to the large cap space as far as the investor is concerned. But we think there are very good opportunities in the mid cap space where there are quality companies, and we've tried to give them some exposure there as well. So if you look at the fund over a period of time, the mid cap exposure has averaged between 20 to 25%.
Right, but what is the focus more on at any given point in time, risk or returns, or does that keep changing given the mandate of the fund and given that there is exposure to both the large cap as well as the mid cap space?
I don't think it's an either or kind of situation. We have to look after both risk and return. So risk adjusted return is what the focus is on.
Right, and what is the expectation on that front? Is there a benchmark that you follow?
We do have a benchmark. Obviously, the fund, given the fact that there is some mid-cap also in the portfolio, should do much better or relatively better compared to a large-cap portfolio in the long run.
Energy is a mainstay in this fund. What has been your approach towards some of the energy names? Because it runs the regulatory risk. Within the segments that are there, upstream companies, downstream companies, gas utilities, where is your interest right now?
We have some exposure to the resources space. For example, stocks like Coal India or GMDC in this fund. Apart from that, we do have some exposure to some of these stocks in the downstream space, OMCs. We think that OMCs have been beaten down quite a bit, and there is some value there.
Do you think there's potential of re-rating there as well, given all that's happened over the last 2 months with the price hikes and the talk of complete deregulation?
It's a very tough question to answer. It's like waiting for Godot. I think there are a lot of things the government has to do for the re-rating to happen. But having said that, some of the OMCs have managed the cycle quite well, and valuations seem extremely attractive.
So you're building positions in oil marketing companies?
We do have some exposure across portfolios.
The next fund is Franklin Smaller Companies Fund, which is a small cap fund. What I've seen is over cycles, this fund has been able to at best match the returns of the benchmark. Is that a conscious strategy, given the volatility and the risk that small companies come with?
Clearly, I think we expect to do much better than what we've achieved so far. It is navigating the small cap space is tougher than navigating the mid and large cap space. So we've had some issues in the kind of stocks we've invested in the past. We are trying to correct that, and hopefully it will lead to better returns going forward.
What is the strategy with managing the fund right now?
The strategy is to not spread our investments across more number of names. It is strategy is to have a more concentrated portfolio. Strategy is to invest in stocks which have a cash generation potential with low leverage and which are a play on the domestic theme.
I see interest in stocks such as Pidilite Industries or a Berger Paints. Paints as a sector has been drawing a lot of interest in the market. What's been the philosophy or your rationale behind picking such stocks?
Both these stocks which you mentioned, interestingly, are a good way to play the real estate theme. Instead of playing the real estate companies, one way of playing the real estate is through paint companies, for example. And if you look at almost all the paint companies in India, they've capitalized on the boom in real estate demand. Pidilite, again, given the strong brands it has, like Fevicol, again is a good way to play the real estate theme.
Also across your funds, not just for the smaller companies fund, but across your funds, I do not see much exposure to autos, which is also touted as a big consumption theme. Two-wheelers or four-wheelers. I see more exposure to the auto ancillary space. Why is that?
There are quite a few auto ancillaries which have pricing power. And again, taking exposure to the ancillary space is a good way of playing the auto theme as such. And if you look at our portfolios, we have exposures to companies like Bosch, which has strong IP, and that helps us to earn above average returns.
But you don't see value in autos right now? It's not a sector which is high conviction?
We do have some exposure, but again, auto is a theme where, over the years, if you looked at our portfolios, we've never been overexposed.